Hello again, everyone, and welcome to Index Options for Income. Today, continuing on, I'm going to talk about another very popular option spread. This would be the calendar or time spread. This spread has been around a long time, and it can be very useful in many different market environments. So let's get started with me sharing my screen, and we'll take a look at my TD Ameritrade Analyze page. Now, as you can see here, I already have it set up here. This is what a calendar would look like, but I want to go through the components of it again. So if I go over here, the way you would set up a calendar is you sell an option that's in a nearer term expiration. In this case, this is the 3rd of March. And then you would buy an option in a later term. In this case, I just have modeled the 7th of March, which would be 4 days later. And now in a calendar, both of the options need to be the same strike. So if we're trading here at 40.79, many times you do it right around the money. There can be different uses for doing different things than that also. But let me go ahead here and we will go on to analyze by calendar. And what happens is, if you look down here, it populates it where it sells the 3rd and buys the 6th, because that is the very next option date. But we can change these around, and let's make it the 7th. Now, the fundamental reason that a calendar works, and the reason it's called a calendar, is because options expire faster and faster as they get towards their expiration. So obviously, if I sell the 3rd, it's going to expire before the option at the same strike there for the 7th. So we're trying to take advantage of the fact that the 3rd is expiring before the 7th. And if we look at it here, each option has its own theta decay. So we can look here at the 40.80, and we can see that its theta decay is currently $2.29 a day. That means every day that passes, it loses $2.29 of its value. Currently, it has $47.50 of value. But every day that passes, it loses $2.28. But the one that we bought out in March, the 7th, only loses $1.97 a day. Now, I wanted to point out one more thing to you. The further your short is from your long, the faster, the larger that difference will be. For instance, if I just go to the 8th, look what happens. It only loses its value, sorry about that, at $1.93 a day. And if we go out further, it will be more and more. But obviously, another problem with this is it costs more, too, if you're buying further out options. So we're trying to take advantage of this fact that the 3rd is expiring faster than the long at the 7th. And that difference is how we're going to make money. That's one of the ways. Now, another way you can make money in a calendar also, or lose money, is that it is long Vega, meaning long volatility trade. Anytime you buy an option in a further out expiration and sell one in a nearer options expiration, you're going to be long Vega. What does that mean? Well, as we can see back here, every option has its own implied volatility. So if we look at the March 3rd, it has a 15.6058. It's bouncing around a little implied volatility. And the long has a 15.44. Now, the implied volatility is all driven by all the interest in an option, the buying, the selling. The more interest there is in an option, then the more implied volatility it will have. The more implied volatility it has, generally, the more it's worth. So that being true, if I sell an option like we're selling the 3rd and I hope to buy that back cheaper, I would like to see it lose its volatility, right? Because it'd be worth less, or at the very least, not get any more volatility. And the long, I'd like to see maybe gain some implied volatility so it's worth more because I own it, or at the very least, not lose any. Now, in a calendar spread, they could both go up as long as the long keeps pace with the short, or both go down as long as the long, once again, does a little better, or at least doesn't get worse than the short. But, for example, if you look at it here, it says we're long $46.59 Vega. Think of that as $46.59, even though it doesn't have a dollar sign in front of it. What that means is for every point of volatility that goes in our favor, say, for example, our long went up a point and the short did nothing, that would be 1 point in our favor because our long is now worth 1 point more. We would gain $46.59. Now, that's an unrealized gain, but you'll see it in your account. The same would be true if our short went up a point and our long maybe stayed the same. Then we would lose $46.59. So whenever you're using a calendar spread, it's always best if you could put those on in a lower period of volatility. As of the last year or two, I would say you'd really want to look at the VIX, which is the volatility index that the CBOE uses to show the level of fear in the market for the SPX. The higher the number is, the more fear there is. When the market goes down, usually the VIX goes up. If the market goes up, usually the VIX goes down. And we would really like it to be under 20 if we were going to put on a calendar spread for best results. So you'd look at this and go, okay, it's 21.22. That's a little higher than I'd like it to be. Doesn't mean you couldn't do the trade. It would be better, though, if it was under 20. So as time passes, once we have this trade on, and you can see it would cost us like $7.85. As time passes, look at the theta difference. Every day, we would be gaining $30.91 in positive theta. You can see this is a positive number. So every day that passes, we make $30 more just because of the rate of decay of the short we sold being so much faster than the rate of decay of the long. Now, that right there can make us money. Theta is always going to be positive in this trade. That's not going away. Then the other factors we have two others. One, the Vega, which I just explained. So volatility could actually help you. What if theta's decaying as it would, and maybe volatility goes up a point in your long, stays static in your short? You're going to make another $46. So it can actually help. And as I described, it can actually hurt you. If that volatility is going down, you will see this particular graph, for instance, if volatility is going up, will get taller and wider. So you can see the size of your calendar and its profitability will get better. But if volatility was going down against you, it would shrink in and lower, often described as running your air conditioning with the windows open, right? Time's passing, but it's not helping you like it should because volatility has gone against you. So it's very important to hopefully be in this trade in a lower volatility time whenever the volatility, the VIX, being a mean reverting instrument, has a better chance of going up if it's already low than if it's high, it has a better chance of going down. So this can be a very profitable trade, an excellent trade to use in the lower volatility environments. And it's definitely a staple of income option trading. I love to do it here in the SPX myself. You know, I like the SPX because it doesn't have single stock risk. Of course, there are factors that move the SPX around, you know, Fed announcements or what have you, but not single stock risk like you could have, say, in an Apple, where the CEO could change, or maybe their earnings were poor or great. Any of those things can make that stock move a lot, where the SPX, of course, is a blend of 500 stocks, so you don't really have single stock risk like that. But this is a very useful tool to use in indexes. And I hope you've enjoyed this basic primer on calendars. And I hope that you can go forward and practice these on paper and eventually perhaps use those in your portfolio if option trading and calendars are right for you. So have a great day, folks. I will talk to you the next time. Bye-bye.